Michael Burry is a well-known investor who gained fame after being featured in the film The Big Short, which chronicled his successful bet against the housing market in 2008. However, his reputation as a bubble predictor and lucrative investor dates back further than that. During the COVID-19 pandemic, Burry once again took a skeptical approach and shorted the market. After a difficult year in 2020 when stocks consistently declined in value, many people agree that Burry was correct in his prediction. His latest focus is on the alleged bubble in the index fund and passive investing markets. Burry believes that the bubble in passive investing has already burst, but the consequences of this have not yet been fully realized. Passive investing refers to the opposite of active investing, in which the investor takes a more hands-off approach to selecting their portfolio by investing in an index. Burry believes that this approach is problematic and has contributed to the current market bubble. He argues that the passive investing bubble, which has been inflating for the past decade, is different from previous market bubbles. Many people have blindly followed traditional investing advice and consistently invested small sums of money into the S&P 500 without realizing the potential consequences. When the market begins to decline, these investors may try to sell their positions, but there may not be enough buyers to accommodate all of the selling, leading to further declines. Burry has not only expressed his concerns through tweets, but has also provided more in-depth analysis of the issue. Burry shared a link to an academic research article titled "In Search of the Origins of Financial Fluctuations," which supports the idea that the current market is being influenced by a bubble in passive investing. The article suggests that when $1 is invested in stocks, it results in $5 of incremental market value. And with 90% of millennials, who are expected to be the future wealth owners, invested in passive market vehicles, this ratio is likely to become even more exaggerated over time. The COVID-19 pandemic and potential inflation may not necessarily change this trend. Burry argues that this ratio is not natural, but rather the result of a paradigm, and he wonders what may continue or reverse this paradigm. He notes that while the ratio may increase to 100 to 1 or decrease to -5 to 1, parabolas do not tend to resolve sideways. In other words, the value of the market will likely experience a significant change, rather than remaining stable. Essentially, Burry is suggesting that the use of leverage, margin, and other forms of debt in index funds creates a bubble in the market. Burry recognized that the market was experiencing a bubble in passive investing as early as September 2021, 3 months before the start of the bear market of 2022. He believed that this bubble was the result of a paradigm, specifically the use of fractional reserve banking, fiat currency, and debt creation by the Federal Reserve. However, he did not know exactly how the market would be affected. At present, with rising interest rates and the shift from quantitative easing to quantitative tightening, it is possible that the market is undergoing a paradigm shift and that the inflation resulting from the COVID-19 pandemic may cause the current system to break down. As mentioned before, Burry believes that the market will experience a significant change rather than remaining stable. In addition to Burry's analysis, other indicators such as the Buffett indicator, which compares the total value of all U.S. stocks to the country's GDP, can be used to identify a bubble in index funds. The Buffett indicator can be calculated using either the total value of the S&P 500 or the Wilshire 5000 compared to the country's GDP, or the difference in value between these measures and the U.S. economy. This indicator compares the valuation of American stocks to economic activity and was signaling that stocks were overvalued at the end of 2021. Historically, the indicator has usually been in the range of 50 to 100%, but it rose significantly during the dot-com bubble, reaching a peak of 140%. In recent years, as quantitative easing and money printing have increased, the indicator has risen again, this time reaching a record high of over 200%. Since the end of 2021, stock prices have fallen, causing the indicator to also decline, but it remains above 150%, indicating that the market may still be in a bubble and that the passive investing bubble may not yet be over. Burry has also tweeted about the lack of active investors in the market. Burry believes that there are fewer value investors in the market today compared to 2002, and he considers these investors to be essential for a functioning market because they help to determine the correct prices for assets. Without value investors, bubbles, including those in passive investing, are more likely to occur. In recent years, active investors have focused more on hype and growth rather than value, contributing to the current market conditions. Burry suggests that the market may continue to experience difficulties, and that passive investing will play a significant role in the market's future. He has also hinted that he is currently shorting the market. If you are concerned about the market performance this year and want to diversify your portfolio or protect against inflation, you may be considering adjusting your investment strategy. In this scenario, some investors were putting 3% of their money into Tesla as part of their investment in the S&P 500, even if they were not necessarily interested in Tesla specifically. This additional buying pressure for Tesla, facilitated by index funds, caused the price of the stock to rise even further. These investors were not participating in price discovery, meaning that they did not consider the actual value of Tesla when making their investments. Similarly, Apple, which was worth nearly $3 trillion and made up 7% of the S&P 500, was also receiving a large influx of investment from index funds without regard for the company's actual value. As a result, these companies were becoming larger and attracting more investors, simply because they were already large and had a significant number of investors, rather than based on their intrinsic value. The lack of price discovery in these cases can contribute to the growth of market bubbles. This phenomenon of increased investment and buying pressure for companies in the S&P 500, facilitated by index funds, occurs across companies of all sizes and affects every company in the index. As the S&P 500 is a widely followed index, many investors are advised to invest in it, leading to more attention and investment in the companies it includes. The resulting inflows of investment drive strong returns and further investment, pushing the value of the index up. This can create a bubble not only in individual stocks but also in the index as a whole. This is a concern that many people had following the COVID-19 pandemic, as a large number of people had cash available and turned to easy-to-use investing apps like Robinhood to invest in index funds, leading to the growth of the world's first major index bubble, according to Burry. As the market has declined throughout the year, the first-ever index fund bubble is currently crashing. The worst of the collapse would be triggered when investors are forced to sell their passive investments, even at a loss, in order to meet their basic needs. Some people are skeptical of Burry's analysis and believe that he is a one-hit wonder who does not know what he is talking about. Regardless of whether the bubble has already burst or is still deflating, the current economic situation is unfavorable. Thanks for watching. I'll see you in the next video.